Hello, learners. Welcome to our session today again. I am instructor CPA Ringo Frederick, and in our class today is going to be a very interesting class. The reason is, in this session, we're going to cement clearly the concept of capital assets pricing model by looking at an illustration question. But before we look at this question, just a brief on what we did in our previous class. Recall, the concept is Capm. And anytime you're talking of Capm, what should come at the back of our mind is that we'll be measuring our risk by using what? Beta, by using basically a beta coefficient or beta factor, right? The reason why we are talking of beta here, you'll find that I am looking at a form of measure of risk that basically we will be looking at a risk that affects the entire industry, not ideally or rather it's not affecting a specific company but the whole industry, and this risk we refer to it as a systematic risk. So in systematic risk, you'll find that the company will not be having a control over what is happening in the market. The concept of systematic risk and where Capm falls, and these are what basically we handled in our last class. So to cement this concept clearly today, I'll want us to look at an illustration question. This question will basically open our mind wide when it comes to the concept to do with capital asset pricing, without forgetting that under systematic, basically, we'll also be looking at risk-free rates. Say, for example, like, or rather risk-free investments. Say, for example, like when I've invested in treasury bills, or when I've invested in treasury bonds, you'll find that these are 100% risk-free form of investments, which I'm certain that I'm going to receive an investment. I'm going to receive a return out of my investment. And therefore, that is to say, for us to determine the return of our security, when you are talking of Capm, basically, we should always recall that I'll be having our risk-free, my good students there, the risk-free rate. We are going to add our expected return of our market. In this case, you're going to deduct our risk-free. Finally, we are going to incorporate what? Our beta factor, either if you're talking of our security or if you're talking of our portfolio. So this is what we must always tend to have at the back of our mind. So once we have that in mind, my good students, you'll find that the whole concept of Capm will always evolve around what Mwalimu has clearly stated there. So let us jump straight to this question of ours and see what we were requested or what we were required to do. So that is Capm. I've shared the question there with us. I believe all of us were able to view that question, believing that all of us were able to view that question. So looking at this question, going through it briefly, these are what we were told, that I'm having this company, Market Ventures Limited, an institutional investor holds shares in 4 companies as shown below, where in this case I'm having A, B, C, and D, and you're having the number of shares given there as well as the market price per share. So my good students, anytime we are having market price per share and the number of shares, what should always come at the back of our mind is the concept of valuation or value of our securities or investments. This value will basically assist us to determine our weight. That is what I wanted to stick at the back of our mind. That is what Mwalimu will wish to stick at the back of our mind. Then additional information, we are told that the expected return on equity of each of the shares is as follows. I'm given company A, B, C, and D, and we are given our expected return for each company. Then note 2, we are told that the expected market return is 17.1%. Then I'm also asked here, or we are told that the return of the 90-day treasury bill is 9.9%. So once I'm given that, of course, we should always recall the concept to do with what? We should always recall the concept to do with risk-free. We should always recall the concept to do the risk-free rate. Required, I'm told that determine the required return on each of the shares in the 4 companies above, and hence advise Market Ventures Limited on the worth of each investment in the portfolio. Worth of each investment in the portfolio. This is what I'll always want us to be very clear with. Anytime we are dealing with the concept of capital asset pricing model, my good students, and we were asked here on the concept as per the way this question had asked us to determine the aspect of the worth. If you're asked to determine the worth, you should always remember that what the examiner wants us basically to determine is what we normally refer to as what? As the alpha value. Alpha value. Alpha value ideally will always determine this by taking, of course, our expected return of course, the security that you are having minus our return of the security under Capm. So this should give us what you are referring to as alpha value. And alpha value, remember, in this case, it will give us the worth. That is, anytime you are asked of the worth. And at any given point, whenever you are having your alpha, if your alpha is a negative value, if your alpha is negative value, that is to say that that investment or security is what? Is inefficient. Is inefficient. When you are having your alpha value, if your alpha value is positive, this investment or security is super efficient. And you have, when you're having your alpha value to be 0, that is to say this investment of ours is efficient. This is what I'll always want this to stick at the back of our mind in the event that we are dealing with the aspect to do with our alpha values. Remember, this will clearly state us, because I'm looking at the difference between, of course, our Capm and the expected return of the security or investment that we are having. This is very important, and you should not confuse this with the one when we are looking at the CML equation, capital market line equation. For capital market line equation, basically, we'll be looking at the value, if the firm is either undervalued, overvalued, or correctly valued. That is when we'll be talking of what? CML, capital market line, which, again, there are so many questions that we're going to look at in relation to that. So this is very important for us to always have at the back of our mind when you are talking of capital asset pricing model. And that is in the event that we were asked of the worth of our investment. In the same case, we were asked in our question there. So once we have that in mind, my good students, let us check out. We are also asked to determine the expected return and the required return on the overall portfolio of Market Ventures Limited, and hence we need to comment on the worth of the portfolio to the company. So that is the case where examiner wants us to determine the worth of the portfolio. So I'm going to squeeze this question here. That is the event whereby the examiner wants us basically to determine the worth of our portfolio. And to determine the worth of our portfolio, you find that basically is very simple. Why is Mwalimu saying it is simple? Because the same concept will apply. So here I'll be looking at the worth of our portfolio. I'll be having the expected return of our portfolio minus the return of the portfolio. This is as per Capm. So these are what you should always be having in our fingertips. So to do that, first of all, we want to determine the worth of this investment, the worth of each investment given. So allow Mwalimu to erase here because you've clearly described and we've analyzed that question the best way we could. So let us start working. Let us start working. Let us start working. So the examiner here, according to our question, he wants us to determine the worth of these investments, right? And to determine the worth of our investments there, we've said ideally I should be having the expected return, or basically return of our securities, the expected return of our securities minus return of our security, that is Capm. That is what we should have in mind here. So clearly that will say that because expected return of the securities were given there, my good students, for our question, that is to say we must determine basically what? The return of our security, basically that is what? Under Capm, capital asset pricing model. And Mwalimu clearly had shown us how to work it out. Return of our security, in this case, we are talking of capital asset pricing model. We should be having our risk-free, okay? We add our expected return of the market minus our risk-free here. We multiply by our beta factor. That is what we should be having, correct? Come to our question. Let us see the investments that we are given. If you can check clearly our question, we are given how many investments, my good students? You are given 4 investments, right? And on these 4 investments, basically, we were told that we had A, B, C, and D. So I'll be having here A, B, C, and D as per what I'm given. Risk-free, which you are told in note number 3, the return on the 90-day treasury bill is 9.9%. So my risk-free basically is 9.9. We need to add expected return of the market. Expected return of the market was given in note 2. The expected market return is 17.1 minus our risk-free, which is 9.9. We need to multiply the beta of our investment or security here. The beta of our security, that is beta coefficient of security or investment A, I'm having 1.044, right? The same procedure I'd be having here, 9.9 plus return, expected return of the market, times the beta of investment B, which is 1.152, right? We should be having C, 9.9 plus 17.1 here, minus 9.9 into basically 0.81. That is a beta of security of investment C. Then 9.9 plus 17.1 minus 9.9, beta coefficient of investment D, I'm given 1.35. So my good students, at this point, that is to say we can clearly establish our capital asset pricing model, return of the security, which will be simple. Mwalimu is going to take his calculator here, then let us work it out together and see the results. So we're going to start with number 1. I'm having 17.1 minus 9.9 times 1.044 plus 9.9. This should give me 17.31. We are told in 2 decimal places, right? The other one should be we should be having 17.1 minus 9.9 times 1.152 plus 9.9. This should give us 18.19. 18.19. The other one I should be having 17.1 minus 9.9, right, times 0.81. This should give us 5.83. 5.83. Not 5.83 because we need to add 9.9. So I should be having here 15.73, right? Believing that that is what you're getting, the same with Mwalimu. Then finally 17.1 minus 9.9 times 1.35, of course, plus 9.9. This should give us 19.62. 19.62, right? So once we have this basically our Capm values or return of our securities here under Capm, then I know very well basically we should be able to determine our alpha values, right? So our alpha values here, I'm having A, B, C, and D. Our return of our expected return of these securities, according to our question there, my good students, what was I given? Of course, I was given, look at note number 1, expected return, right? Expected return, we had 17.55, we had 21.60, 15.75, and finally 20.70. We have determined basically our Capm returns here. So Capm, we are having, of course, 17.31, 18.19, 15.73, and 19.62. So what would be our alpha values? Our alpha values, I should be talking of 17.55 minus 17.31. This should give us 0.24. 21.60 minus 18.19. This should give us 3.41. Then I should be talking of 15.75 minus 15.73. This should give us 0.02. 20.70 minus 19.62. This should give us 1.08. So by our results, basically here, we can establish what do we have if we are to advise. Of course, if we are to advise, you'll find that we should basically accept, because in this case, this is more than 0, which is super efficient. Accept. This also we should accept. That investment is good. Also, this one is not negative, therefore we should accept. Then also here we should accept, right? Because all these investments actually, they are good. All these investments actually, they are good. All these investments, they are good. All these investments, they are good. So that is what you are required to work out in basically number 1. So that is what we should be having, and I believe you guys, you follow the procedure up to this point. Believing that you guys, you follow the procedure up to this point, because this is all these are like super efficient, because ideally they are not 0, they are more than 0. So this is what we should be having. Okay, so once we are done with part 1 of the question, let us proceed to part 2 of the question. Let us proceed to part 2 of the question here and see what we will be having. So what were we asked to do in part 2 of the question, my good students? In part 2 of the question, this is what you are asked. Determine the expected return and the required return on the overall portfolio. On the overall portfolio of the Market Ventures Limited, and hence comment on the worth of the portfolio to the company. So again here, what you are required to do basically is to comment on the worthiness of our portfolio. This time round, not investment, security, but ideally our portfolio. So that is simple because I know very well that to determine the worthiness, we'll always be talking of alpha value. And for alpha value, basically here, we are talking of the expected return now of our portfolio. Okay, expected return of our portfolio. We less the aspect of return of the portfolio. Basically, this is what? This is Capm. One thing that you should have in mind. Then, the other item that you should also recall here is that for us to determine basically Capm, this risk, talk about basically the aspect of the risk of our portfolio that is under Capm. We should always have this in mind, that I'll always be talking of our risk-free here. We add our basically expected return on the market minus our risk-free here. What you are going to incorporate now is beta of our portfolio, beta of the portfolio. That is very important for us to always note. So in our question here, let us start by identifying what was the expected return of our portfolio. Expected return of our portfolio, recall, for us to determine our expected return of our portfolio, we'll always be having, of course, like in this case, I should be having the weight of A. We multiply by the aspect of return of security A plus weight of B, return of B, plus weight of C, return of C, plus weight of D, return of D. That is very important for us to always note. So once I have this, you'll find that things will be very, very easy on our end. And how will you determine our weight, my good students? To determine our weight, we must be having the values of this investment. And in our case here, of course, I'm having investment A, investment B, investment C, and investment D. So what were we given? We were given our shares. And these shares, basically, if you can check it out clearly, we were told that if assuming like in this case I can take our figures to be in thousands, I'm having 120, we're having 160, we are having 200, and we are having here, my good students, 250, right? These are basically the number of shares given here, number of shares. Okay, our market price per share, I was given 64.35, 43.80, 32.55, and 47.10. What I was given there, right? So once we have that case, we can clearly come and determine our value. Right now, I can remove this question of ours. So in this case, I should be talking of our value basically here. We should be having 120 by 64.35 to give us 7722. 160 by 43.80, that should give us 7008. 200 by 32.55, this should give us 6510. 250 by 47.10, this should give us 11775, right? So total plus 6510 plus 7008 plus 7722 this should give us 33,015. So having that case, can you determine our weight? To determine our weight, that will be very easy, because our weight now will be for investment A, I should be having 7722. Basically, we want to determine the proportion of that to the total, right? That is what we are talking of, the weight. So 722 divided by answer here, that should give me 0.23. 0.23. The other one we should be having, of course, the other one we should be having here, that is 7008. We divide by 33,015 to give us how much? 0.21. 0.21. 6510 divided by 33,015, that should give us 0.20. 0.20. Then finally 11775 divided by 33,015, this should give us 0.36. 0.36. If we add all this together, that should give us what? 1, right? So once we have determined our weight, our work will be very easy. We just need to determine the expected return, therefore, of our portfolio. So to determine expected return of our portfolio, I should be talking of our weight of A, which is 0.23, times the return of A. The return of A, what did you have as our return of A? See, these are the figures that you're having. And of course, these are the same that we had in our question, which in this case, my good students, if you can still confirm that, I believe you've taken a screenshot of the question. This is what we have, you see? These are what we had in note 1. In note 1, expected returns. So that would be easy, which ideally I'll just pick what we had here. So this should give us basically 17.55. We add 0.21 times 21.60. 21.60. Of course, we are going to add 0.20, the weight. We multiply by this return, which was 15.75. 15.75. And finally, should be having here the weight 0.36. We multiply, of course, here by our return, which is 20.70. 20.70. So that as at the end of the day, that should give us our return of the portfolio to be what? In my calculator, I'm going to have it directly 0.23 times 17.55, believing that you're doing the same with Mwalimu. 0.21 times 21.60, 0.20 times 15.75, 0.36 times 20.70. So this should give us 19.17 if at all you are to take it into 2 decimal places, which you can confirm with your calculators. I'm getting 19.17. I'm getting 19.17. So once we have that, of course, that should give us basically our return of the portfolio, right? Return of the portfolio. Let us come and determine, basically, this will give us basically this aspect here, the one that you're talking of, this return of the portfolio, right? Expected return of the portfolio, correct? Now, my good students, what about the return of the portfolio under Capm? Return of the portfolio under Capm, I know very well I should be having risk-free plus expected return of the market minus risk-free over the beta of the portfolio. So beta of our portfolio, recall this one, we did it in our previous class. We did this in our previous class, which I can remember very, very well. So the same case, to determine that beta of the portfolio, we should be having the weight of A times beta security of A. We need to add weight of B times beta of B. We need to add weight of C times beta of C, then plus weight of D and times beta of D. Right? That is what we should be having. So this should give us the beta of our portfolio. That should give us the beta of our portfolio. That should give us the beta of our portfolio. And once we have that, my good students, in mind, things will always be very easy. Let us see. Weight, we have already determined our weight. And the beta factors, we had our beta factors here, which ideally they're the same which were given in our question. So how will you work it out? So therefore we can agree that beta of our portfolio, therefore we should be having, in this case, I'd be having my weight of A, which is 0.23, times beta of A, which is 1.044. We add weight of B, 0.21, times beta of B, 1.152, 1.152, correct. We add weight of C, which is 0.20. We multiply by beta of C, which is 0.81. We are going to add, of course, the weight of D, which is 0.36. We multiply by beta of D, 1.35. So that as at the end of the day, what will we be having? That should be 0.23 times 1.044, 0.21 times 1.152, 0.20 times 0.81, 0.36 times 1.35. So this should give me a beta of 1.13. Kindly you can confirm, my good students, kindly you can confirm. So once we have that in mind, then things will be very easy here, right? This is the point whereby you should start smiling because you have all the variables right, because you have all the variables. So what are we going to do? This is what we need to determine first of all. The return of our portfolio under Capm. I'm having risk-free will not change. 9.9. We add expected return of the market will not change. 17.1 minus our risk-free 9.9. We multiply now by our beta of the portfolio, which we have determined it here to be 1.13. So that as at the end of the day, I should be talking of 17.1 minus 9.9 times 1.13, 8.136. We are supposed to multiply, or rather to add 9.9. So therefore I'm getting here, basically here, of course, I'm getting 18.04. 18.04. So our main aim was to determine the worthiness of this portfolio. We need to determine our alpha. Look at this case, expected return of the portfolio, which is 19.17, the one that we are determining it here, which I know you can clearly see that. Then we less our return of the portfolio under Capm. This is what I'm having, 18.04. So therefore, what should we be having? 19.17 minus 18.04. In this case, I'm getting 1.13. So ideally, this is what? Super efficient. This is super efficient because ideally it is a positive value. Our alpha is positive. Our alpha is positive. And basically, that is what we are required to do in this question. Following the procedures right, working them out correctly, we are going to achieve these results. You can clearly see that it is a very simple concept that if you have all the procedures at the back of your mind, things will always tend to flow. And that's how easy advanced financial management is, right? So in our next class, my good students, what if we are looking at scenarios whereby you are not given the beta of the securities? You see, like in this case, you're given the beta of the securities, right? What if you're not given the beta of the securities? How will you determine the beta of the securities? That's a concept that I want us to study in our next class in this revision of ours, right? So to that point, guys, thank you so much for following Mwalimu and also studying with us. Let us meet in our next class where we are going to handle a different concept of Capm. Thank you so much, guys.